All right, what the heck just happened to the stock of Twilio, TWLO? From the beginning of last year through the past July, the cloud-based communication service stock was red hot. Twilio helps app developers embed communications functionality into their own programs to connect with customers. Think these text messages you get from Lyft or Airbnb. I thought it was a great story, and that's why we crowned it one of our cloud kings and bought it from my charitable trust, which you can follow along by joining the ActionAlertsPlus.com club. But alas, Twilio peaked at 151 over the summer. And since then, the stock has lost 39% of its value, sinking to 91 as of today. At first, Twilio seemed like merely one more casualty in the market's rotation out of those high-flying cloud stocks I talked about at the top of the show. Nothing more. But recently, we've seen there's some serious company-specific problems that must be addressed. For instance, last week, Twilio reported a mixed quarter with solid results but not so hot guidance. Plus, management revealed a billings issue that caused them to issue $5 million in one-time credits to a piece of customers. Then just yesterday, the company announced that a calculation error had caused them to overstate their full-year earnings forecast by 4 cents a share. That's not nothing when you consider that the company only made 3 cents a share last quarter. So the stock tumbled from 97 to 92 on top of everything else. Twilio is now at its lowest level since January, having given back nearly all of its gains for the year. It's been a brutal experience for my charitable trust. As much as we love this company, and you know we do, investors are suffering. People on Twitter are angry at me. I don't blame them. Patience is wearing thin. We need some answers. So let's check in with Jeff Lawson. He's the co-founder, chairman, and CEO of Twilio. Get a better read on what's happening. Mr. Lawson, welcome back to Mad Money.
Thank you, Jim. It's great to be here.
Okay, Jeff, I'm glad you're on. You're not ducking these issues. I got to figure out what happened with the with the calculation error. Can you tell us what went wrong here?
Yeah, the calculation error was a simple math error in the press release for our quarterly earnings. The numbers were all the same. They just got added up incorrectly. The guidance didn't change. The mathematical error, of course, is on us, right? We have to make sure to get those things right. And we have instituted additional processes and controls to make sure that such an error cannot happen again. But that is one of the growing pains that we have experienced as we've been growing as quickly as we have. As you can see, last quarter, we grew 75% year over year. On a revenue base that's now well over $1 billion. And so this incredibly fast growth is fantastic, but it's come with some growing pains. And of course, it's on us to get all that stuff right, but it is a cost of growing as quickly as we have.
Okay, I'm not done with this. How complicated is the forecast? Is it a simple financial model, or are there complicated calculations within that went wrong?
Well, the forecast, which is different than the calculation error in the press release, the forecast is, of course, complicated. We have 172,000 customers that comprise our customer base and well over $1 billion of revenue. So as you can imagine, that's a complicated forecast. And what we had as far as the error in the billings was a simple clerical error of data entry.
So let's separate those two. Let's deal with the forecast now. We're going to take the error. We're going to trust you and say that was a calculation that just made a mistake. But this forecast is very important because we need to know whether some underlying assumptions changed given the fact that you have all this growth, or whether this is just a very hard thing to do.
Gotcha. No assumptions have changed. Nothing about our forecast has changed. It is a simple mathematical error of adding two numbers. That was an omission when we were proofreading the press release that got caught actually by an investor because all the information was public and was fixed in the revised update. And so nothing changed about the business. All the inputs look incredibly strong, and we are as confident about the future of the business and the massive opportunity ahead as we have ever been.
Okay. Did someone go back to the correction? Did someone review that before to make sure it made sense? I mean, look, you're a billion-dollar company, and you're a brilliant man. And so I candidly did expect better of you, okay? I think, Jeff, I have to just say it like that because there is no doubt that you run a great company, but a calculation that was wrong, a forecast assumption that wasn't right, these are not things I expect from you, Jeff. I just got to put it out there like that.
Absolutely. It's on us to get the simple calculations correct, and that's why we have instituted more processes and controls. And there were multiple people who proofread the documents and looked at the calculations. Unfortunately, they were all missed. And so we've gone back and said, what is the root cause of how multiple people can look at a calculation, and are reworking that process to make sure that back to the root source of that data, it's got multiple people calculating every one of those things. Because of course, it's on us to give investors the best and most accurate information. And so we take that to heart, and we have gone and are working on that infrastructure, and we've fixed several of the root causes, and we're in the process of fixing a few of the other things.
Would something like this actually impact your business? Are there people who are staying, who might be leaving the company because the stock's not going up?
No, I don't believe so. The fundamental market that we operate in is still enormous. I mean, helping every company out there, big and small, new and old, traverse this digital landscape that they now have, and using these digital channels to connect with their customers, that is an enormous opportunity. And nothing has changed about the very large market we're serving and the incredible growth rates we're seeing. In fact, customers are pulling us towards this opportunity, and that is what's fueling our growth. And obviously, we have to continue investing in the infrastructure, the systems, and the processes to be able to keep up with that growth, and that's exactly the investments that we're making.
How about we do this? How about you promise to our viewers right here, this is not going to happen. I know there are things that go wrong, but that you personally are going to take it upon yourself to be sure that these problems are not going to happen again, because I know that you're better in these problems, Jeff. You're smarter in these problems, and I know you can lick them. Is that a fair promise to our viewers?
That's a fair promise. I commit to everybody that I am on top of these, and my CFO is on top of these, and we are ensuring that the processes that we're putting in place are there to make sure errors like this don't happen again.
Fair enough. That's what I want to hear. You're a gentleman for coming on the show. Thank you to Jeff Lawson. He's the CEO and co-founder, chairman, and CEO of Twilio, TWLO. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.